Welcome back to the Neuro Finance Masterclass.
Welcome back to the Neuro Finance Masterclass.
We are so incredibly pumped for today's session. This is day 61 of the 365 Days to Financial Freedom series, and wow, things are really heating up. Over the last few days, we've equipped you with some incredibly powerful tools, right? We gave you the RSI thermometer to gauge market temperature, and we handed you the moving average compass to track the overall trend.
Exactly. But today we complete your fundamental technical arsenal. We're moving beyond those indicators to look at the raw price action itself. We are going to draw the actual, literal battle lines right onto your charts. Let's dive right into this, because what we're breaking down in this explainer completely changes how you view a stock's movement forever.
There's a famous market adage that goes, the price doesn't just stop falling or stop rising randomly. It bounces off invisible lines. This is massive. The average person, they look at a stock chart and they see total unpredictable chaos, just jagged lines moving up and down on a whim. But actually, scratch that, it's an absolute illusion. It really is. When you strip away the noise and just look at a stock's history, you realize there is this invisible architecture guiding the price. It's not random at all. The price movements are incredibly deliberate. They are bouncing off these invisible, historical barriers. And on Wall Street, these critical barriers have very specific names: support and resistance. And honestly, this brilliantly illustrates the difference between an amateur and a professional. The amateur guesses. The professional sees the invisible lines.
To really understand these lines, you have to picture the high-stakes trench warfare happening in the order books every single day. On one side, we have the bulls. These are the institutional buyers with literally billions in liquidity ready to deploy, and their sole mission is to defend the floor.
Right, and opposing them, you have the bears. These are the sellers with massive inventory guarding the ceiling. When the price hits a certain historical premium, they swoop in, algorithmically lock in their profits, and ruthlessly push that price back down. Every single day the market is open, these two massive forces clash. It is a literal tug of war fought with deep capital. And the battle lines where they repeatedly clash, those are your support and resistance zones.
So let's break down the first of these battle lines. Let's look at support. Support is the invisible floor. I want you to imagine you're holding a rubber ball and you drop it from the ceiling. What happens? It falls, accelerates, and then smack. It hits the ground and bounces violently back up.
Right, because it can't go through the solid floor.
Exactly. In the market, a support level acts exactly like that floor. It is a specific historical price point where the massive institutional whales and liquidity providers have historically stepped in. Whenever the price drops down to this invisible line, the market collectively looks at the asset and says, wait a minute, this is heavily undervalued. And instantly, massive buying pressure floods the zone, pushing the price right back up.
And here is a wild fact to wrap your head around. It's not just humans defending this trench. There are literally billions of dollars in algorithmic trading bots programmed to execute buy orders the exact millisecond the price touches this historical floor. That's how fortified this line really is.
Now, we flip that concept entirely on its head. Resistance is the exact opposite of support. It is the invisible ceiling. Right, so think about that bouncing ball again. That ball bounces off the floor, shoots up into the air, goes way too high, and bam! It hits the ceiling and gets smacked right back down. A resistance level is that ceiling. It's a specific price where the sellers take total control of the narrative. The market hits this line and collectively says, whoa, okay, this is way too expensive. Institutional algorithms immediately start offloading their inventory. And here's the crucial point you've got to remember. It doesn't matter how much retail hype is brewing on Twitter or how much good news is pumping on TV. The price will fundamentally struggle to break through this specific historical barrier because the overhead selling pressure is simply too heavy.
So the bouncing between the floor and the ceiling is incredibly predictable. You can make good money just trading the bounce. But we aren't here for just good money, are we?
No, absolutely not. We are here for life-changing wealth. The breakout is where true wealth is made. The real opportunity, the climatic moment of this entire masterclass, lies in the exact second these invisible barriers fail.
You can almost feel the tension building, right? A ceiling can only absorb so much buying volume before the sellers just run out of inventory. A floor can only withstand so many drops before the buyers step aside. Eventually, something has to give, and when it does, the predictable bouncing turns into an explosive market event. Let's walk through exactly how this explosion happens. First, the bulls attack the resistance ceiling again and again, but this time they bring massive volume. They bring the heavy artillery. Second, the selling pressure is finally exhausted and boom, the ceiling shatters. The price breaks out and literally skyrockets to a brand new level. And this brings us to the third phase, which is quite frankly the golden rule of technical analysis. Write this down, highlight it, tattoo it on your brain. Once a ceiling of resistance is broken, it automatically becomes the new floor of support. That old roof that you just violently crashed through, that is now the strong, solid ground you stand on. The entire paradigm of the chart has shifted upward. It's beautiful.
So the crucial question is how we actually use this information. It's time to pivot from theory to action. We are introducing the mindset of the architect.
Oh, I love the architect mindset.
It's everything. An architect doesn't rely on feelings or hype or what their neighbor is buying. No way. An architect relies strictly on structure. Your cognitive task for today, right after this explainer, is to look at a stock chart and actively draw these horizontal lines where the price has bounced multiple times in the past. You need to map the blueprint before you build a house.
Let's crack open the architect's playbook. Your first move is to map the history. Draw those horizontal bounce lines to find the invisible architecture. And here is the absolute golden rule. Never, ever buy randomly in the middle of a room. If the price is floating in no man's land, halfway between the floor and the ceiling, you do nothing. You sit on your hands.
Because buying mid-room is just gambling, plain and simple.
Exactly. Instead, you wait patiently for the price to drop down to a strong support line, and you execute your buy exactly at the floor. Why? Because it protects your downside with history. Buying at the floor provides massive asymmetric risk. We talked about this back on day 51. Your potential reward going back up to the ceiling is huge, but your risk going down is tiny, because that floor is actively defended by billions of dollars in liquidity.
And that brings us to this incredibly empowering takeaway. When you adopt the architect strategy, you are no longer guessing, you are calculating. It completely changes the game. It removes all the anxiety. Think about the average retail trader for a second. They buy a stock just because it's green that day, and then they're panic selling 3 hours later because of some random Reddit post. They're entirely driven by emotion. But the architect has icy, calculated patience. They know where the invisible lines are. They know exactly where they'll enter the trade and exactly where they are wrong. Emotion is completely removed from the equation.
So stop guessing in the middle of the room. Find the floor. This is day 61, folks. You have the tools.
We challenge you right now, as soon as this explainer is over. Open up your charting software, pick the stock you watch the most. Don't look at the news, just look at the raw price action. Can you see the floor? Can you find the ceiling?
Find those historical bounce levels. Map out the architecture. But ask yourself right now, is your portfolio currently built on a solid floor, or are you just floating midair waiting for gravity to kick in? Go draw your trenches. We will see you tomorrow for day 62.